Ladies and gentlemen, we now shift our focus to the market outlook. May we now call back our Chief Investment Officer, Mr. Mike Enriquez, and his team. Cristina Gabaldon, Head of Equities and Research, Richie Teo, Head of Fixed Income, and Nico Vergara, Head of Global Funds. Mr. Enriquez will be moderating this discussion.
Okay, thank you, Moy. So good afternoon again, everyone. Thank you for staying. And I think this would be a fruitful afternoon for us to have a discussion on where we are currently, and we'll try to answer where we're headed, at least in the next 6 months. As you may have experienced, I think we have been here in the lockdown already for the last 4 months. The economy has been starting to go back to normal. However, we have also been seeing that the rate of infections continue to move higher. So there's again that threat that we might go back to a stricter lockdown, as we have been seeing as well in the other global markets. So this afternoon, I've brought here my team on, at least we can shed some light on how we see the different markets, from the global to the local interest rates, and then finally to the domestic equities. So with that, I'll hand it over to Nico to give his short views on the global markets. Nico?
Okay, thanks, Mike. So for the people in attendance, I think we have one slide that we can show for while I'm discussing this. Okay, so for people who've been with us, since last year, it's been a roller coaster ride. This will be the second year we've seen negative earnings for the S&P. In many ways, it's been a challenging environment for all the asset classes, whether fixed income or equities. For people who've been holding on to bonds, particularly credit-laced products, you may have noticed maybe sizable drawdowns in the first quarter. Some investors may have a perception that bonds don't move that much. But I think in the way markets are structured, the information flow, developments in different parts of the world, they trickle through all the asset classes. So I think if you've held your bond funds, especially the offshore ones, through the first and second quarter, you would have seen a sharp drawdown, followed by maybe a recovery of about 1/3 to 1/4 of that drawdown. So I think for equities, it's been much more on the headlines. We've had good rallies from the US to Europe to HX Japan, in some ways in the Philippines. So what's driven that rally? We think about it that governments, regulators have come in a big way to sort of support their own, their stakeholders, their economies amidst the COVID challenges we're seeing. COVID sort of affected business models for different people in different ways. So companies who were actually weaker before this event started find themselves in an even more challenging situation. I think at the peak of the market correction, the peak or the most headline risk investors were worrying about was the spread of the virus and a potential debt crisis for companies globally. So how do measures right now sort of alleviate that? So the Fed, the European Central Bank, the Bank of Japan, they've come out in a big way to make sure SMEs, households, and big firms have access to capital. I think one thing which we want to dwell on, it's the importance of having these policies stay in place until we see robust and continuous recovery across different markets. I think regulators would, the last thing they want to do is pull away the support until they see strong, green shoots move up from here. So on sentiment, I think moving into 2020, people were actually less invested in equities than they were historically. So why is that? I mentioned earlier, this is the second year we'd see negative earnings. So the risk now there, people are worried, how can the rally continue? how can companies' valuations move up? One thing that's pushed that up, it's really a decrease in bond yields. If you've been following treasury yields, the 10 years yielding less than 1%. When we started the year, it was closer to 1.9. So I think the desire for people to hold on to yield or search for yield will continue to push people towards the direction of riskier assets. So I think the counterpoint to that, no, how we manage that risk, it's sort of, we need to look at the assets we're buying into and totally or thoroughly understand what we're buying into. So I think for the team, the goal is not to seek out the highest yielding asset, it's to seek out assets which are backed by strong fundamentals and can continue to rise up regardless of the new COVID environment we're seeing. So I touched on the bond yield and the equity yield. No? So right now it's quite attractive. Equities are yielding at about a premium of 6 times versus the bond yield. So this is something you see very often. I think if just to frame it, no, this is 5 standard deviations above the normal. So it's quite attractive for people who want to come into the market. So for the team, we remain constructive. We think outperformance or positive returns will be very sector specific moving forward. No? Some companies will do well. Case in point, Microsoft and IBM. For IBM specifically, no, they released their first their corporate earnings. Their CEO, Arvind Krishna, he actually highlighted the strength of the migration to cloud. One point I took away from his speech or his disclosure was that only 20% of workloads have moved to the cloud. So that's something similar we've seen with Microsoft, in that their plans to sort of move efforts into cloud computing have sped up compared to what they could have done without this rush. I'm sure you're seeing this also in preparing for your children's schooling, right? There's been a buildup in laptop demand. So it's something which is happening globally. So there will be sectors who will respond positively to this and companies who will be more challenged. So I ask you to stay with us for the panel discussion later. I think we'll be able to thresh out a little bit more ideas and throw ideas across. Thank you. So I'll turn you over to Richie, our head of fixed income.
Okay, good afternoon, guys. All right, so for fixed income, if there's a message that I'd like to convey to all of you, that is yields are going to stay low for longer. Actually, if you look at Fed, BSP, they all already came out to the market saying that they would retain the easy monetary policy for probably 1 to 2 years out from here. This is all because of the pandemic, and we've seen, as Miko mentioned a while ago, that they are waiting for those green shoots. What this means to our fixed income market is that would be positive as rates can stay low. But if you dissect further on how we manage our portfolio, since we also take some tactical trades, we also think that with the low interest rates right now and the need to raise some funding, especially for the programs to combat the slower growth brought about by the pandemic, we think that there would be more issues that we can take advantage of. Right now, as everyone might know, the government is already embarking its second RTB, Retail Treasury Bond offering, this year. And it's projected to be even higher than the biggest one issued last Fed. It might be more than 310 billion. And after that, we think that there would be more flurry of supply coming from corporates and even BSP. So that's one of the things that we're looking at from the market right now that might challenge some of the bond yields that we've seen. So even though it would remain low, the supply might present some opportunities to load up later on rather than right now. The government, BSP, has already cut RRP by 175 basis points to 2.25% right now. While for RRR, they've cut it by 200 basis points, so from 14% to 12%, all in support of the economy. We've also seen the BSP going into the market and supporting bond prices as well. In terms of making this sustainable, maybe this would be sustainable as long as the economy would still need it. But when we do see those green shoots, we would need to be nimble and fast enough to act, as these are unprecedented low yields right now. So to put in context, the RTB 5-year that's being issued, that is below 3% already at 2.625%. In terms of our strategy, we think that there would be value in there, given that that would be traded heavily. So we'll continue to look out as the offer period would go all the way up to August. Moving over to the dollar fixed income, pretty much similar story, as we think that the low yields would also be maintained there, as what the Fed mentioned to the market. In terms of our local dollar bonds, the ROPs, they're quite expensive as they've come for the past few years with spreads going down. So that might prove a little bit of a challenge, although for our funds, we can go outside of ROPs, which would again provide some opportunities for our funds. Lastly, for the money market funds, dollar starter funds, peso starter funds, we've seen yields go down. So the time deposit rates also went down. So we can expect that the money market funds could see a deterioration of the yield. Although right now, it still maintains its strategy and its positioning of yielding better than time deposit rates. And we think that we can hold on to this given our unique strategy of participating in some corporate bond issuances in both peso and the dollar space. We can talk more about this in detail later on in the Q&A. For now, I'll pass you over to Gabs for the local equities outlook. Thank you.
Thanks, Richie. Good afternoon, everyone. So this is the PSEI chart. Right now, we closed at 6064.26. We're up 22.4% year to date. What we see in terms of technicals is that the resistance of the market is around 6.5 to 6.7 level, while support is at 5,900. Things we are looking out for would be the second quarter 2020 earnings result that could surprise the market, whether positively or negatively. Next slide, please. So looking at the valuation of the market, during the GFC levels, we were trading at a multiple of below 10 times. Right now, based on our house call, we're trading at a multiple of 14.91 times. Consensus is at 17.64 times. Comparing that to the 5-year average, we are at par with a 5-year average of 17.8 times. Versus the MSCI Asia ex Japan, we are cheaper than the region. So it's might be a good time to invest in the local equity market now. Next slide. So things we see positively and negatively. Firstly, for the positives, we see a lot of fiscal and monetary stimulus going around. Like what Richie has already mentioned, the BSP is very accommodating. On the fiscal side, the government is spending as well to cushion the impact of this COVID-19. We have seen the economy move from ECQ to now GCQ. And as we reopen the economy, we will see more activity, and it's positive for corporates. Philippine equity market is undervalued right now compared to bonds. Equity yield is at 6.7 versus bond yield right now, which is at 2.2%. This is a very wide spread, and given this, it the risk you're taking in equity might be worth it. For the negatives, well, there's still no vaccine yet. We have seen the cases in the Philippines rising. We are the highest in our region. 2Q earnings could be worse than 1Q. In 1Q, if you remember, there was the Taal effect and the lockdown effect starting mid-March until the end of that quarter. So in 2Q, it could be worse, just to manage expectation. And then the foreign investor sentiment on the local market remains weak. Fund outflows have reached $1.38 billion year to date. Next slide, please. Here you would see the gray line is the 10-year bond yield. The gray line is the earnings yield. The green line is the 10-year bond yield. And you can see that wide difference there, which makes investing in equity attractive, depending, of course, on your suitability in that asset class. Okay, that's it for me.
Okay, thank you. Thank you, Gabs, Miko, and Richie. So probably we can have the screen stayed on the earnings yield to bond yield. And I think that's a good place to start the panel discussion right now. And you've provided a good point there, Gabs, that the spread between the implied equity yield versus the bond yield is really very wide at the moment. And this is not only true for the Philippines, also global, even in the US. So probably going to Miko, right now, equity markets have really gone up in the US. But in spite of that, the earnings yield versus bond yield there continues to be wide. And right now, they're especially talking about global markets. US is the one that's leading it. And you know that it's a presidential year now for the US market. And clearly that spells a big difference on where we think equity market is or will be at the end of the year, or even closer to November's election. So what's your take on this? Do you see that the equity market will continue on with its strong rally with a Trump win, or what will happen if Trump loses?
Okay, thanks for the question, Mike. I guess one thing, we've seen equity markets rally about 30%. It's a good move from the bottom. So it reflects the view by global investors that regulators have come in a big way, and that the support will sort of trickle down into the companies that they work for, into their own households, and support their livelihoods. The other risk you mentioned, more than a risk, the catalyst you mentioned is the elections. There's arguably statistics which argue which kind of administration is better for equities. No, there's some by the Financial Times, there's some from Bloomberg, but if you highlight the one since 1976, I think in that one from the Financial Times, it's been more beneficial for equities in a democratic sort of administration. Again, things can change, but one thing which we have to contend with, in spite of that statistical occurrence, this is potentially a change in regime if the Democrats win. So markets don't necessarily like volatility. The status quo is generally the better place for equity markets. So if we do see, for argument's sake, that Biden does win, his move or his incoming presidency would impact sectors in a different way compared to the Trump administration. In many of his talks, Biden's been more, I guess, hardline on the banking system. So there may be some challenges for the sector there. He's talked about implementing some financial transaction taxes, which could, cut down some of the volumes for different exchanges. He's talked about looking more into M&As for specific companies. He's talked about launching a public credit bureau to compete with the more established private credit bureaus. One more thing I think is sort of closer to home, no? Student loans are a big part of the banking system in the States. He's actually looked at or discussed eliminating tuition fees for select colleges and making it free for families whose income is less than $125,000 per year. So that kills or reduces loan origination, at least for student loans, no, for some banks who rely on it. So you could see some changes in terms of multiples for these banks who are affected by it. One other thing which is mentioned, they could look at technology taxes on Facebook, on ad spend. So a change in regime could change the dynamics of the current market, especially the guys who've outperformed it. So there are good and bad things. We may see a dialing back of foreign aggressive trade and foreign policy. I think other countries would take that as a positive. It's arguably benefited the US that Trump has taken these stances, but it's yet to be seen. We need to see how, if ever he wants to bring capability or capacity back home to the US, how it plays out. Companies need to plan for that, and I think we've seen a drop in private investment. Same with business investment, because companies are wary of getting whipsawed by the changes in policy.
Okay, thanks. And moving on to further to your point on the US, I know it comprises a big portion of the global fund strategy on the US markets, but the other developed markets have continued to and also rebounded as well. And what's your take on the other markets in Europe and in other Asian markets, especially North Asian markets, where we have seen a recovery of their equity markets from pre-COVID levels, in fact?
Yes, that's right, Mike. So I think the performance of the US has been quite good, So if you were invested in the funds in January, didn't look at any newspaper, you're referred back to it today, I think would be quite flat or just a little bit off where we were in January. So I guess that sort of communicates the need to just let investment outlets pan out and take longer term sort of horizons for the things we do. I think for managing this crisis, asset levels depend on this the COVID pandemic not spreading. Case in point, the US has done well, but I think only 20 out of the 50 states in the US mandate a strict form of wearing of facial covering. So only 20, less than half of the states. At different state levels, it's based on your city and municipality. So the lower government levels have to come up with their own policy to implement it. So that's one challenge. That's one risk we're looking at. So you see Florida, you see California, I think there's a voting aspect to this. So I don't think the government can really, railroad in one way to mandate that. So there's many sensitivities we're managing or looking at also. But that being said, I think once we look at next year's earnings, we're coming from a very low base this year, so that's beneficial, So for the US, I think Street's looking at a decline of about 17% for earnings this year. Next year, most major markets, it's closer to 30%. So again, it's from a low base, but I think that's what people are looking at now, that rollover point. Once we roll over to next year's earnings, it's mechanical, but it is the way markets compute valuations. Mm-hmm. We cool down. For the US, we're at 26 times earnings. It cools down to 18 times, closer to the long-term average once we go to next year's earnings. So I think the base case should be policy needs to stay the same, and there should be continued management of the spread of the disease in the US and major markets. For Asia, I think that's where we're putting more of our effort. We are an emerging market. We're in that basket. So there's more inefficiency in the markets here. So I think we can squeeze out more alpha. One thing we're looking at, it's breaking up the Asian ex-Japan basket. So one thing we're doing, it's not buying the basket anymore. It's looking at specific parts of it who are better and who are worse. China went into this situation earlier, no? So it has the advantage of coming out sooner as well. So we've seen that in its equity market. It hasn't returned to 2015 levels now, but it's moved up significantly from its bottom mid first quarter also. So we're looking there. Their earnings are quite robust for this year and next year. So again, it will really be sector and country specific, I think, succeeding moves for markets.
Okay, so shifting gears a bit on, since you mentioned about continuation of policy or particularly monetary policies, and right now we have been hearing from the market players low rates for longer or even low rates forever. So I think that's something a bit worrisome, especially for bond investors, that we haven't really seen much yield for bond investors. So Richie, what do you think? Our interest rates will continue to stay low, or will there be a point of adjustment down the road?
Thanks, Mike. So I think rates can still stay low. However, definitely some room of adjustment. For our house call, we're actually calling for another 25 basis points cut from BSP for the year. But again, that would still depend. That can accelerate or that may reverse depending on how our economy responds to the pandemic. But right now, we think that they still need to maintain this easy monetary policy. But what are the other side of that coin? Inflation is one. With the loose monetary policy, we might actually see inflation inch up. So last month, we already saw it go up to 2.5% because of some increases from logistics. And then later on, for the last quarter of the year, we will see that inflation will be coming from a low base effect. So to recall, last quarter, that's when inflation hit below 1%. Mm-hmm. So if last year's fourth quarter saw below 1%, for this year, that may see heightened inflation. And with higher inflation, that may cause yields to go up as well. Another factor that I think why yields can still go up despite easy monetary policy from the policymakers is supply. A while ago, Gabs also mentioned about fiscal policy. So the Congress right now is still trying to pass a fiscal policy, which the country really needs. And with this, there would be additional supply. So with that additional supply, yields can go up on a technical basis, even though policy rates might stay anchored at current rates of 2.25% or even at 2%.
So yes, you've also mentioned a while ago the government has recently launched this new retail treasury bond, and I think as of the last thing I heard is it's about 250 billion already, to close to 300 billion in terms of commitments from retail investors and various institutional investors. So this would be, I think, the biggest issuance to date of retail treasury bonds. But at 2.625% gross, do you think it offers some value at this point in time? So, but at the same time, how does it compare to our peso short-term fund?
Okay, thanks, Mike. There's actually two answers to that. If you're just trading the market, there might be some value to it, as the 2.625% of the RTB 5-year is actually yielding higher than where secondary market trading is. So currently, the 5-year bonds are at 2.3%. So that's about 32 basis points higher for the RTB. That makes it kind of interesting. But that's just for the short-term trade. For the long-term trade, or even before we go to long-term trade, let's just compare holding that RTB and compare it with time deposit rates, or even more applicable, money market funds. At 2.625, that's only 2.1% net of taxes. For the money market fund, like for our peso starter fund, it's yielding at 2.5% net currently. And with a while ago, I mentioned that there are risks of higher yields versus the money market funds stable returns. That makes it a little bit dicey in terms of retail going after RTB. Last I heard, yes, it's around 250 billion already. And I'm pretty sure that they will try to issue a lot more, making it the biggest one. But in terms of retail take-up, it hasn't really flown yet, unlike the past few RTBs. Maybe another reason there is, to put in the context, this new RTB is one of the lowest in terms of coupons being issued. The only RTB that were issued lower were two RTBs issued during 2013. So that's 1.625 and 2.125. And both of them didn't fare too well during that time, mainly because of the taper tantrum. But it also goes to show that psychologically, it might be also something that's a little bit harder to hurdle, especially for retail money that are quite particular on the final yield that they will be getting at. And if you compare that with inflation, we're looking at negative real rates already, since it's lower than where inflation is.
Okay, so thanks, Richie, for that. And I think for us investors, as I mentioned, there's really not much value now for interest rates. And Gabs, do you think it's worthwhile for investors now to really look at domestic equities, given, as you mentioned a while ago, there's a wide gap between the implied equity yield versus the prevailing 10-year bond, which unfortunately is closer to the 5-year retail treasury bond yield. But as a caveat to that, we've also observed that our own Philippine equity index has lagged behind its regional peers. So what do you think are the factors that are affecting that? And do you think it's time for us to really look at domestic equities at these current levels?
So, that is true. We have lagged our peers. We are in the same category as Jakarta and Singapore, which has also lagged. I think one reason for it is the COVID cases that we have. We don't seem to have it quite under control. Lately, we've been having cases close to the 2,000 number. We are actually the highest in ASEAN, us followed by Indonesia, then Singapore. So no wonder our stock markets are as such. So the capacity of hospitals is quite stretched right now. I think in Metro Manila, it's around 76%. And I think this is affecting the local equity market, definitely. Another reason I'm seeing is the heightened regulatory risk. We've seen that with the non-renewal of the franchise of ABS-CBN and statements that the president would like to dismantle oligarchs. This also is not helping the local stock market. It's affecting sentiment. Some foreign investors are scared of this situation. And I'm not even considering the possible geopolitical risks, and the 2Q earnings might come as a surprise as well.
Surprise to the upside or the downside?
Mixed.
So speaking of earnings, 2Q earnings or first half earnings results, and I think it's forthcoming already with the start of some of the banks already have reported, like BPI. What do you think would be the sectors that can continue to weather this pandemic, and your bottom sectors are the ones which you think would really not fare well in this type of situation?
So in terms of our strategy right now, we are overweight on property, banks, and telcos, and we are underweight on conglomerates and utilities. Uh, we we like the property and banking sector. We think when the economy recovers, these sectors will recover. But in our portfolio, we chose the higher quality names. Like for banks, we want a bank that is more exposed to corporates rather than SMEs, for instance. For the property, we like property names that have a strong balance sheet and could weather this storm, rather than the smaller property names out there. For the telcos, we see this sector as being a defensive sector, yet it has growth. Broadband is like the thing now. This new normal has changed the way we work. So we are doing our stockholders meeting via Zoom, and it has changed the schooling of the kids as well. So this is the new normal, and there's growth in the telco space. For the bottom sectors, for conglos, we intend to play that more via the subs. And for utilities, we still think there's that regulatory risk that could happen anytime.
Okay, so yes, definitely those are some of the sectors that can lead the recovery of the PSEI. What's your take on the big conglomerates that are used to lead the recovery of the PSEI index, which you haven't really discussed it as part of your top sector?
Yes, conglos are affected sometimes by fund flows. Sometimes when there's a big inflow in the index, conglos are the ones that like spike up at the end. But in terms of fundamentals, we prefer the subsidiaries rather than the conglos that typically jump up temporarily because of inflows.
Okay. Okay. And, we have been seeing more activity now in the corporate space, launching new corporate bonds, whether peso and dollar. And likewise, in this lockdown, we've also seen a new asset class emerging, which are the REITs. And finally, we have a new asset class called the Ayala, or the A-REITs, that is coming out soon. In fact, I think next week. So what's your take on this? Do you think this would warrant attention for our investors, especially now where the level of interest rates are?
Well, it's great that they have this new outlet. It might provide some activity in the local stock market, which is quite slow these days. There's not much volume traded. Definitely, this will open up the doors to more companies listing their REIT if this is successful. So some names that are interested would be Double Dragon, I'm hearing. There also is Mega World, there's SM Prime, but it depends on the success of this Ayala REIT. As to yield, it's giving around 5 to 6%. It gives you a better yield if you compare it to fixed income right now. So we're looking at that angle, and we think this is suitable for some balance funds.
Okay, thanks. And speaking of new asset classes, we've also recently launched a new product called the World Equity Index Feeder Fund. And probably, Miko, you can discuss more what are the advantages of this World Equity Feeder Fund, given the current situation, is it the right time to come in, where it's technically a peso denominated fund that is dollar settled?
Thanks, Mike, for the question. I think it's a good complement for existing active positions. The thing I would prefer investors not to do is to compare it between the Voyager and our other active mandates. No, so it serves a different purpose. It's really access. It gives you beta or index exposure to complement active positions. Like Mike said, we've sort of insourced or taken away the burden from clients to actually do the conversion on their part. So again, we take care of that part. We just buy into an ETF which copies the MSCI ACWI. So for the audience who haven't seen the primer, MSCI ACWI, it's the biggest global stock market. So in the same way that the PCOM is the barometer for stocks locally, MSCI ACWI is the barometer for global equities. I think it's a good combination to have, especially if you're primarily peso. Taking dollar positions diversifies you from the currency standpoint as well. I think inherently, if you look at it, there may be some apprehensions investing offshore, but statistically, it's actually lower volatility, or it moves up or down less than the PCOM. So I think if you were to sort of size your positions, you can keep that in mind. It sort of diversifies you. It brings down your portfolio risk incrementally. One other interesting tidbit, it's invested in about 2,000 companies offshore. So compared to the 30 stocks we buy with a local index, it spreads the investment over a bigger set of companies across different indices and sectors. So in the local market, if we're primarily financials and conglos, buying the product or the world equity index feeder gets you access to sectors we don't have locally, say financials, tech, healthcare. So I think again, it's a good way to spread out the portfolio.
Yeah, that's a good point, Nico. I think given the limitation of the local index for 30 with just a few sectors compared to 2,000 plus stocks in several sectors globally. So definitely that gives our investors an opportunity to partake of global recovery, especially as the market is really just hovering at certain levels right now where we haven't really seen the full recovery take shape. And I think now going back to more activity on the corporate space, Richie, we have seen a lot of new issuances, as you've mentioned, not only from the government, but also for corporates. We have seen new bonds that are being floated, both peso and dollar. Is this something positive, or will this drive liquidity out of the system? And why are they doing it in the bond market rather than just borrowing from banks?
Yeah, I think most of the companies are taking advantage of the low yields while it's still there. So they would tap into the capital markets. That could be more diverse as well, rather than just going to the bank, especially right now with the low yields. So there's a lot of incentive for them to do that. And we haven't seen the last of them. I think some of the corporates are just waiting for the jumbo bonds like the RTB to be issued before they go out to the market.
Mm-hmm.
In the peso side, we've seen issuances more on the 2-year, 3-year, but not really on the 5-year. But once the RTB 5-13 gets out of the way, then expect a lot more 5-year corporate papers for the peso side. On the dollar side, I think most are doing it not only because it's cheaper in a way versus peso, but it's faster to issue. And they can tap also foreign investors. We've seen Tel, Globe, Mega World, a lot are issuing every day. There's a new issuance. What this means is just in basic economics, demand and supply, with a lot of supply, there's some risk that demand might not be enough to get all of it or for them to fly after issuances. That's why it's very critical that we choose which issue to participate, as not it's not our bullets are not unlimited. In terms of is this good or bad? I think it's good for the companies that they can raise some funding that's needed. But in terms of the general prices, there might be an overhang as we don't see this stopping anytime soon.
Okay. Is it something
Yeah.
alarming? Yeah, sorry, Gabs. Yes.
Just to add to what Richie said, a lot of these companies are refinancing rather than using the money for capex. A lot of corporates actually have been in cash preservation mode and have cut down their capex.
Okay. And do you think that this is a bit alarming now that a lot of these corporates, do you see defaults happening in the near term because of the current situation for the bond or some of the equity names that we have?
Yeah, so let me tackle first on the credit side. Maybe Gabs can talk about more on the equity later on. For the credit side, we do employ our credit analysis, and some of the big names we're not too concerned. As what Gabs mentioned, it's really more about refinancing and not really increasing their leverage. So this is good on their side, as they can tap the markets while they still can. So it's not that alarming, but for the smaller ones, that might be, especially if they cannot tap the market. They issue and then they can't tap. That's the more alarming one for me, because that could cut down their source of liquidity. But so far, I think right now the government is also doing what they can to ensure that SMEs can get access, will have that lifeline available for them. But we will be on the lookout, especially on default rates. Right now, we really haven't seen default rates yet locally, but it's something that's a valid concern.
Okay. So probably I'll pause here a bit to check if there are questions from the audience. Moy, are there questions which I haven't tackled yet?
Yeah, so I have here a few questions from the audience that I'd like to you guys to tackle. One of the questions here is, what does new normal mean for Sun Life Asset Management? Will there be shifts in the way the funds are managed in order to pandemic-proof them? Maybe we can go around the table and ask first on the equity side. So, Gabs, perhaps you can share with us what's your strategy on the equity side to make our investments pandemic-proof?
Okay. I actually answered the question earlier. With the way we manage the funds, we are making sure that the names in our portfolio or where we're overweight on are quality names that could weather this pandemic. I'm not sure about pandemic having no impact on the funds, but we are definitely trying to minimize the impact. So we don't have exposure to sectors that are most at risk, let's say the airline industry or tourism related. So we don't have those in the portfolio.
Okay, and while we're at it, do you have a year-end target for the index?
Okay, for the index, our house call is that it would be 6,800.
6,800. Thank you. Richie, maybe you can share some of your strategies to make our investments pandemic-proof on the fixed income side.
Yeah, pretty similar with what Gabs mentioned, especially on the credit side. On the government side, there's not much we can really do about it, as this is a government. So we just really need to be nimble. And I think it's good to highlight process-wise on how we do things. It can be said that it's pandemic proof, as our work from home protocols are also very robust. We can do it. It's not really affected. So that's one. In terms of the strategy, yeah, just keep close watch to those specific names that are affected. But right now we're really avoiding them, so we don't have any holdings or exposure to them.
Thank you, Richie. Maybe over to you, Miko.
I think one thing we've done, no, we've really tried to enhance the research process. Again, parang that's really where we try to drive a lot of the alpha. So it's understanding the markets we're investing in to a better degree, you know. So whether that's looking more into their economic data more stringently than previously. I guess another thing is adjusting our multiple targets, you know. So like in a good market, when you don't have this sort of healthcare scare, PEs can really shoot up. But I think in dialing that expectation down can sort of temper the price targets we assign also. One thing that's helped also, I think for year to date, I don't know if it's a factor of the work from home or the uncertainty. I think we've sort of taken bigger bets via less moves. So I think portfolio turnover has been lower. So somehow that also reduces friction costs for the portfolio.
Thank you, Miko. I have another question here, and really anyone from the team can chime in on this one. If I have extra cash, please tell me 3 best funds to invest them to have a more balanced portfolio.
Probably you can say the equity, the fixed income, and so one of the global funds. But you have a fixed income exposure, you have an equity exposure, and you have a global exposure on the dollar, at least on the currency. You also have some diversification on the currency.
Thank you, Sir Mike. One more question here. I have a money market fund. Can I change it to a high profitable investment? Maybe I can add my thoughts to this one. So if you're invested in a money market fund and you want to shift to any of our funds, you can do so for as long as it's in the same currency. So if you're talking about the money market fund, that's peso denominated. The answer is yes, you can shift to other peso denominated funds as well, which can potentially give you higher returns. Okay, so let me read a few more questions from our Q&A box, and the next two are for Gabs. Gabs, why do you think banks have a more negative outlook compared to other stocks, and they haven't recovered V-shaped in both the US and the Philippines?
I guess people are considering the possible defaults that could happen. Another thing is we have not seen the economy really recover, but if it does, banks will lead the way. What I'm seeing now with banks is that they are heavily provisioning for losses in the first and second quarter. Come 3Q, they will get a better picture on their borrowers. And then hopefully by fourth quarter, we could see some sort of or semblance of recovery.
Okay, thank you for that. We have some questions here which relate to the recovery of the market. And I know you've mentioned, Gabs, early on that our year-end target is at 6,800. I think some of the investors may have been or may have entered the market close to 8,000 or 9,000 level. Do you have any forecast maybe for 2021 or even longer than that one?
Okay, for 2021, this is just our back of the envelope forecast. We're targeting 8126. That is an EPS of around 492 and EPS growth of 18.7%.
Okay. Thank you for that one. Let me read off a few more questions from our Q&A box. Do you think IPO of REITs is a good investment? Or maybe to add to that, will we be participating in any of those?
Okay, for the REITs, we are going to participate for one of the balance funds. REITs might lag the recovery in the equity market because by its nature, it pays out almost all of the earnings as dividends. It's a defensive play, I would say. Um, it's a good alternative to fixed income. So that's how I would look at that asset class.
Okay, thank you for that answer. A good alternative. We have a question here, and anyone can answer this one. What is your take in cryptocurrencies like Ethereum? It seems that market is quite aggressive in these types of investment.
No comment on cryptocurrency. Sorry, unless the rest of the guys have any.
No, haven't had the exposure.
Okay, no worries. Someone here asks if we can maybe give a forecast for our dollar bond fund or the dollar advantage fund. Maybe an upside.
Yeah, so for the dollar abundance, which is pure fixed income, I'll let Miko tackle on the dollar advantage. As we think that yields can stay low, we can see it continue its positive returns. So for the year, right now it's at 0.65%. So maybe for end of the year, it's quite reasonable to expect a year end of 1% for DAB, dollar abundance.
And maybe for dollar advantage.
Maybe to frame it differently, we've DAF's really centered on it's inherently weighted in growth and large cap names in global stocks. No, it has one sector which I've been sort of keeping an eye on. If you look at the S&P, there are only two sectors who are trading below their historical PEs. One is energy, one is healthcare. So it depends on the reason it's trading below its average, right? So isn't it interesting that in this market where we've seen the US move up so fast, so strong, that there's still a sector or two who are below in terms of PE. So I think one thing we're waiting for is the healthcare sector to really move. I think it should trade closer to parity with the S&P's PE. So right now it's at a discount. I think many factors moving that. No? So part of it is change in policy. There potentially, I think Democrats were looking at it in a way, capping sort of drug prices, some policies impacting the way insurers could charge, member holders. So I think if these headwinds are sort of addressed or taken away from the table, I think the sector can rally from this level, no? And I think move closer in terms of parity with the S&P in general. So that's something that hasn't moved in a big way yet for the DAF.
Thank you, Miko, and thank you to everyone for sharing with us their insights with regards to the market. That's all of the time we have today for our Q&A. And just a reminder to everyone, the link to the recording of today's session will be sent to you via email. But before we let our fund managers go, maybe we can go around the table and ask them for some last words of wisdom for our investors listening. Maybe we can start with Gabs.
I guess for me, buy when there is blood in the street. And that's now, I think.
That's now. That's great. Short but sweet. About you, Richie.
Yeah, same with the previous closing remarks. So stay invested. Let the fund managers worry about it for you.
Okay, Miko.
Yeah, so you're just if you have questions, though, talk to your advisor. This new environment may change some of the horizons or the requirements people have. So if you think your objective is different compared to what it was before, don't be afraid to ask for help, at least in terms of rebalancing the portfolio.
That's right. You can always consult with your financial advisor. Sir Mike.
So just to a parting word for everyone. Again, thanks for joining us and staying up until 3 o'clock. And I think the team has already expressed it. I think there's a lot of opportunities down the road given where financial markets are. in spite of the volatility that we have been experiencing, I think it's time for us to really look at our own portfolios and reassess it and stay invested. We have seen markets recover faster than the actual recovery of the economy. I mean, we can see it in the US. They've been increasing their COVID-19 cases, but equity markets are already above pre-COVID levels. Definitely, we can see that as well as our own economy starts to reopen. So with that, we need to stay invested, whether on fixed income. I think there's still room for rates to continue to go down, and more so for the equity markets, for those who can take on the equity market risk and volatility. I think it's high time for us to not to be missed with this opportunity to be able to get value. So with that, thank you everyone. Thank you, Moy, for hosting.
Okay, thank you to our fund managers. And with that, we officially end our Market Outlook Forum. We hope you had a wonderful time with us, and we look forward to having you again in our future events. We send you off with only the brightest wishes for your financial pursuits. Thank you everyone for joining us today. It has been a pleasure having you. This event has been brought to you by Sun Life Asset Management. Stay safe, everyone.